Hi, welcome back to the entry level trading course by Valetax. This is the episode 5 of this course. My name is Ryan, a fair market analyst, and I'm your educator for today. How price moves, supply, demand, and liquidity is the topic for episode 5. And let's get right into it. Stay tuned. We're going to be discussing about how price really moves and what moves price for a better understanding for the beginners who are going to be watching this course, because we sometimes think that prices just moves randomly and prices are just candlesticks. But at its core, price moves because of imbalance. Where there are more buyers than sellers, prices would rise. And where there are more sellers than buyers, prices would fall. So that is the core reason for demand and supply. Demand is the presence of buyers in the market, while supply is an excessive presence of sellers in the market. Now, every move is driven by buying and selling pressure, hence why imbalances creates direction. So if there are a lot of buy orders, it means that there would be a need for people to sell. So view the market as a conventional market in this time around. If people are not buying, nobody is going to want to sell a certain commodity. And if people are selling a certain commodity, it means that it's as a result of what demand or orders for people willing to buy. Same way the market happens, and those are the imbalances. So if someone is actively searching to buy, his orders create an imbalance that sellers need to fill up. That is what creates direction in the market. So price do not move randomly. Now, when prices get into a point where the market is stuck within two range, which we refer to as a consolidation, it's as a result of too much balance. It means that there is no outweighing of buyers from sellers, just enough to go round. So what creates the big moves and direction of the market from a bullish trend to a bearish trend are all as a result of imbalances. But balances just creates consolidations, ranging patterns or ranging markets. Okay. Now, moving forward, what is demand and what is supply? Now, demand is an area where strong buying has entered the market. You will often see price drop into a zone and then aggressively push to the upside. So we're looking at things like the market being bullish in this nature, okay? And then all of a sudden, you get this huge drop and then prices pushes up aggressively. In this kind of area, we would say that we had an area of demand at this level. Now, why area of demand is very important? Because there are huge buy orders usually trapped in these demand areas, and they are very, very key integral points or focus points for a lot of traders, retail, and institutions. Similarly applies to the supply zones. So we have prices in a bearish downward movement, okay? And all of a sudden we get this huge pump to the upside and then prices drop aggressively. Now we can say we have tapped into a supply level because similar conditions affected huge sell orders wanting to fill out a previous imbalance somewhere below. And that is how supply and demand zones really work. So strong reactions happen where imbalance existed before. So the supply level was probably an area of imbalance before. So prices rushed into that level to find the higher time frame or the overall area of imbalance in the current direction of the trend. Okay, when we finally get into chart box in the level 2, we would finally be able to start to understand all of this on the charts better. These are just mere illustrations to help us understand what we're talking about. Now, what is supply? Like I really already explained, it's just the opposite of demand, okay? It's where price returns to anticipate a huge selling opportunity again, where there's a lot of sellers and interest in the market. Moving forward, now we want to discuss what exactly is liquidity. So liquidity is where orders exist, okay? So think of liquidity as this. For every time someone takes a trade, they put a stop loss. What is a stop loss? A stop loss is a trader saying, if I lose this amount of money, I am willing, if prices get to this point, for any time or at any point in time. This is the right amount of capital I'm willing to let go of. So it could be $50, it could be $100. Now, mind you, not one person sees a particular trade at the same place, because then there would be not enough liquidity to drive prices in the market. So it means that there are millions of people who are obviously taking trades and buying currency pairs or assets at a particular price, and they all have their stop losses too at favorable risk positions for themselves. The fact that they are leaving an order, a pending order to exit the market, means that they are leaving money on the table. They're leaving a part of their capital on the table. So that is to say that if we see a huge level where we know there could be possible stop orders at that level, and one of those areas are areas in the market where have been described to be good zones. So we're looking at things like above previous highs and below previous lows. For people who are buying, they try to put their stop losses under the previous lows, and people who are selling try to put their stop losses above the previous high. Those are areas of liquidity, because why? There are a lot of people saying if prices get to this point, I'm okay losing this amount of capital. That already is liquidity. That is how money usually is being cited and placed, and also entries that are placed in the market. Large players target these areas usually before they take trades, because they like to move the market in the opposite direction so that they can have a better opportunity at imbalances to move prices in the direction that they want to move these prices to. And that is how the market operates. And when we go back, we see clearly that price is driven by what buying and selling pressure, and imbalances creates that direction. So they want to create that imbalance where there's one party more than the other, so they can finally drive their positions since they have higher and bigger positions in the market. Now, why do price hunt areas? Price seeks efficiency, meaning that it needs a very clean move in order for prices to range or for prices to trend properly. Market move towards areas of interest. Sharp moves often start after liquidity is taken. So whenever we get that huge momentum in the market, it's as a result of liquidity being taken. So the market now has a proper imbalance to fill up nicely and better. Remember that price moves with intention and not emotion. As a beginner trader, you would probably suffer a lot of emotions, and that's fine. It's your ability to learn to manage them and control them over time that puts you ahead in the market. So stick with it long enough, and you will just be right enough very soon. And until next time, I would see you on the next episode of the entry level trading course. So stay tuned and watch the next episode. Bye.